the Embrace Group, embracing design, thinking, and diversity, changing business. Our client, Abachi Rolling Mills. Our mission is that we aspire to set the example of what a trusted business consulting company is and should be. Our vision is working together with passion, enthusiasm, and commitment to become the industry leader in business consulting solutions. Our team members: Venance Koga, team leader; Faith Maswai, marketing director; Harrison Kyoko, project manager; Felicitas Gapuo, operations director. Our agenda: background study, problem statement, research on the countries of expansion, conclusion and recommendations, references, question and answers.
Background study. MRM is part of the SAFOL group and operates in Eastern, Central, and South Africa. It enjoys major share of the local roofing market and also exports to over 50 countries in Africa, Asia, Europe, and America. So we looked into the problem statement and found that MRM is considering expanding to other countries and needs macroeconomic research that summarizes findings including monetary policy, interest rates, GDP, trade balance, and employment rates and taxation trends over the last 5 years. And as an Embrace, we are having the responsibility to carry research and give the recommendations. So we looked into the macroeconomic trends of the countries of research and got that population of India is 1.3 billion, Egypt 86.7 billion, Saudi Arabia 30.8 billion, Yemen 27.5 million, Nigeria 173.9 million, United Arab Emirates 9.3 million. We looked on the monetary policy and found that the exchange rate is $1 66.30 Indian currency, while exchange rate of Egypt is $1 equals to Egyptian currency of 8.8858. Exchange rate of the Saudi Arabian currency is that 3.75 equals to $1. Exchange rate of Yemen is 250.125 Yemen currency is $1, and Nigerian currency exchange rate is that 199.113 equals to $1. United Arab Emirates exchange rate is 3.6732 equals to $1. Then we looked into the GDP and got that the GDP growth is high in India and inflation stands at 6%. Then Egypt GDP growth is 4.5, the inflation is very high, and GDP growth of Saudi Arabia is at 3.6, while inflation is 2.7. The GDP growth is 0.4, that is low in Yemen, of high inflation of 8.2. 8.1 inflation is high at Nigeria, and GDP growth is at 6.3. Then the GDP growth is 3.6 in United Arab Emirates, while inflation is at low as 2.3%. Then there is trade balance, that is, there is a deficit in trade in India. Then there is deficit trade in Egypt. Then there is surplus in trade in Saudi Arabia. Then there is deficit in trade in Yemen, deficit in Nigeria, and there is surplus in United Arab Emirates. Then the unemployment rate is at 3.6%, 13 in India, then 13.2 Egypt, that is very high. Saudi Arabia at 5.6, while also high in Yemen, 17.4. Nigeria, it stands at 7.5, while United Arab Emirates, it stands at 3.6. Then taxation trends in these countries is that income tax and cooperative tax is charged in India. Then there is income tax and corporate tax again in Egypt. Then there is no income tax and cooperative tax in Saudi Arabia. Cooperative tax is at Yemen, and income tax, cooperative tax, VAT, and capital gain tax is also in Nigeria. Then there is no income and cooperative tax in United Arab Emirates. Then we looked into the pros and cons, that is the advantage and disadvantage of investing in these countries. And we first looked into the pros, that is the advantages of investing in Nigeria, and got that Nigeria has an increasing consumer base due to high population growth. It also has resources that are untapped. Then economy is also growing at a high pace. Then Egypt has a very low crime rate. Then Saudi Arabia has a significant capital to spend. Then Yemen, one of the busiest shipping areas, that is, it has. Then United Arab Emirates has open market. India is democratic. Cons, there is insecurity and poor infrastructure in Nigeria. Then there is high level of corruption in both Egypt, Saudi Arabia, and Yemen. Then there is political instability in United Arab Emirates, and there is political pressure and weakness of infrastructure in India.
We as the Embrace Group found that India is the best place for MRM to take the steel industry and set up there. We looked at competition analysis, supplier. There's moderate to high threat from a new entrant. There's excess demand met by import, steel attributes by four major companies. And there's high costs of exit, bargaining power of buyer, threat from substitutes, moderate low. Then we also looked at steel consumption in India in the last 5 years. We saw that the consumption has grown by about 11%, which has been the highest since 2005. The consumption has reached its highest ever level of 46.78 MT in the year 2006 to 2007. The driving forces are companies are increasing their focus on downstream and solution-driven products for higher value addition, technology improvement, and total investment in infrastructure sector in the 11 5-year plan will be around Rs 20.6 trillion.
Example of competition move used by company in steel industry that MRM should analyze. Then there is Tata, for example, there is Tata Steel, that annual crude steel making capacity of that one. Tata is continuing with its program of expansion of hot metal and steel making capacity. Then it also has, or maybe has, a massive expansion of its capacity through various greenfield projects. Then there is Steel Authority of India Limited produced 3.2 million ton of hot metal, and also grew over the corresponding period of the previous year. SAIL and M/S Rail India Technical and Economic Service (RITES) has entered into a joint venture agreement for setting up of a wagon manufacturing facility in other parts of India. So we looked into the mode of expansion, and before that we looked into the types, advantages and disadvantages. And on the types, we looked into the first type of entry, that is expounding, and we got that it's very fast considering entry. Then there is low risk. Then disadvantage is that you have low control, low local knowledge, potential negative environmental impact on transportation. Then we looked at another type, that is licensing and franchising. and we got that it has also advantage, that is it's fast entry, low cost, low risk, but has less control. Licensee may also become competitor. Legal and regulatory environment must be sound. Partnering and strategic alliance, advantage that they share costs and reduced risk, seen as local entity, then higher cost than exporting, licensing or franchising, integration problem between two cooperative cultures. Acquisition another type of entry is fast, non-established operation, high cost integration is with home office. Then there is greenfield venture. There is gain local market knowledge, can be seen as insider who employs local, maximum control. Disadvantage is that it costs high, has high risk due to unknowns, slow entry due to setups time. Structure of the iron ore market from the supply side. Merchant mining companies in the public sector such as NMDC, OMC or MDC, who sell iron ore either at market-based or government-determined prices. Then there is merchant mining companies, the private sector, who sell ore at market-based price. Then there is steel companies or steel producers, captive mines. Then we looked into the SWOT analysis of India and got that it's slow growth. There is slow growth in infrastructure development. Then unexplored rural market, global economics slowdown, capacity creation to serve the domestic and overseas market, and then unrestricted export of iron ore and other exhaustible mineral resources.
Our conclusion and recommendation is that based on the PESTEL analysis, the strengths and weaknesses of the countries we researched on, we as Embrace Group found India as the best place for expansion, and we consider the facts also the high demand and consumption of steel, especially on infrastructural and automobile industries.
We looked into the references and citation, and these are our references and citations, and we thank you very much for the time you gave us, and maybe if there is question we'll be able to answer. Thank you very much.